An LBO is really just an acquisition where a significant part of the purchase price is funded with debt, whereas the remaining portion is funded with equity that's provided by the financial sponsors. And we're going to use the term financial sponsors, private equity investors, LBO shop interchangeably. They're all basically the investors who provide the equity into an LBO. Now, the company that is bought out via a leverage buyout undergoes what is essentially a recapitalization to a now highly leveraged financial structure. We're going to refer to the pre-LBO company as the old co, and the new post-LBO company as the new co. Now, keep in mind that the companies that are acquired by financial sponsors or PE firms can both be private or public. In fact, the majority of companies that are bought out are private companies, but certainly the public, the go privates as they're called, the public companies that become private via an LBO are the most high profile ones just because they tend to be bigger and there tends to be more news around them. So the basic intuition that underlies an LBO is actually quite similar to the idea of buying a house and financing it with a mortgage. If you've done that, or your parents have done that, or you know someone who's bought a house with a mortgage, they've basically done an LBO. So let's just go through a very simple LBO, which is the process of buying a house. Let's say you buy a house for $500,000, which you finance with $100,000 of your own money. You call the down payment, and the remaining $400,000 you borrow from the bank. Let's say you sell the house 5 years later, and if we assume that you've paid down $150,000 of that original $400,000 mortgage, and the price of the house has increased by 30%, what does the pie look like now? Well, now you're selling a house that's not worth $500,000, but it's gone up in value. It's now $650,000. And now the portion of the value that belongs to the lenders has gone down from $400,000 to $250,000, which means that were you to sell this house, you would be able to put $400,000 in your pocket. You started with $100,000, you put $400,000 in your pocket. That's an IRR of 32%, an internal rate of return annually of 32%, and that's a cash-on-cash return of 4 times. You put in $100,000, you got back $400,000. That's the basic contour of an LBO. The idea, if you whittle it down, the basic idea behind the LBO is find a business, lever it up. In other words, put in very little money of your own, borrow as much money as you can from the bank at as good a set of terms as possible. Try to grow the business operationally so that it increases in value, and try to pay down as much debt as possible so that when all is said and done, your value, the value that you own in the business, becomes greater and greater and greater. So let's talk about the way that this is actually structured. So financial sponsors finance deals with a lot of debt and put up a relatively small amount of equity. As debt is paid down and the value of the business grows, sponsors earn large returns. So the key drivers of success are, I think, fairly straightforward. You want to get in cheap. In other words, you want to buy that business as cheaply as possible. Now, that's true regardless of what type of investor you are. You always want to get in cheap. But with LBOs, it's actually very important to be able to find assets that are deemed to be undervalued in the market, because that's going to accelerate the ability to pay down that debt and unlock equity. Next driver of success is levering with a lot of cheap debt. Obviously, without that leverage, you don't generate the kinds of returns that you would have otherwise. And we can go back to the house example and actually just take a look. If you don't lever this business up, it goes, let's say you funded it all with equity. It'd be a $500,000 house funded with $500,000 worth of equity. Say it goes up by 30%, so you sell it for $650,000. Sure, you generated $150,000 in profit on your original investment of $500,000, but that is by no means a 32% IRR. That's not a 4x. That's that's like a 1.2x or whatever that number comes out to. So leverage is what jacks up your returns pretty significantly. So let's kind of get back here. So getting in cheap, levering with a lot of cheap debt, and improving the business. Obviously, to the extent that you can grow the business, that's going to enable you to very quickly recoup money and generate significant returns. Last but not least, being able to exit within 3 to 5 years at a high multiple means that either you've grown the business and the structural sort of profile of the business is such that people are willing to pay more, per dollar of EBITDA than they would have, when you bought the company. So if you bought the company 7 times EBITDA, you sell it 9 times EBITDA. The way that happens is, one, if you really structurally improve the business, and secondly, if you're lucky and you bought in a sort of macroeconomic environment where your industry and your company is being valued low, but then you sell in good financial times. So that's a little bit of luck as well. So that's ultimately the goal. If you're successful, if you sort of achieve all 4 of these basic drivers. Now, there's a lot more to each one of those, and we're going to spend some time really thinking about each one of those as we build through our models. But let's just talk a little bit more in depth about how those profits are actually generated. So specifically, when we're talking about exiting, what do we mean by exiting? Well, the most common way that private equity firms exit is they sell to a strategic acquirer or another PE firm. In fact, you can tell over the last several years, close to 90 or even over 90% of all exits, of all private equity exits, are either selling to a strategic, which they call here a corporate acquisition, or selling to another PE firm, which they call a secondary buyout. The next option is to IPO, to basically go public, to sell shares to the open public. There's actually a third alternative, which is to do what's called a dividend recapitalization. And this is something that's increasingly common. It's also indicative of kind of a more loose credit environment where sponsors can also monetize without a complete exit by simply giving themselves a dividend financed by new borrowing. So imagine, again, going back to this house example, where you get to this point and you go back to the same bank that gave you that original $400,000. You say, hey, you know what? We were able to pay down $150,000 of that debt. Obviously, you were comfortable with this level of leverage back then. Let's lever this company up again to the same $400,000. So give us another $150,000. So we'll lever it back up to $400,000, and we'll just issue ourselves a dividend. We, being the owners of the business, the equity owners of the business, will issue ourselves a $150,000 dividend. That's called a dividend recap. Very simple process that tends to be a signal that credit markets are pretty loose. There were no dividend recaps during the financial crisis, for example.